Okay, we're getting close to start time. Let's give the participants a few more minutes to come in. I see the numbers going up. That's great. Give it another 30 seconds, minute or so, and then we'll get going, have some fun. Okay, why don't we get going? It's 1 minute after the hour. Welcome everyone to the annual, or I'm sorry, to our monthly educational webinars put on by West End Wealth Planning, IPC Securities Corporation. Today's topic with myself and my associate advisor, William Barreca, are the 6 retirement blind spots that can ruin your retirement because most of us are either missing them or not doing anything about them. So we're gonna have some fun today. We're gonna talk about the 6 major blind spots. We may even have time to go into some more. And we're gonna tell you how to avoid these things moving forward. So again, this is part of our regular monthly, or actually our last monthly presentation until the fall. We're taking off a couple months in the summer. We're gonna reconvene back in September. Now, by the way, during the presentation, if you have a question, please feel free to ask the question. Now, what you want to do is go down to the tab on the bottom that says Q&A. So we're going to try and answer all the questions we have. Don't hesitate. You can also ask those questions anonymously if you like, okay? Now, or if you'd like to ask us a question directly, you can email us at info@westendwealth.com, info@westendwealth.com. Now, we won't be able to answer that during the presentation, obviously, but that's another alternative for you. Now, when I do these presentations, well, what tends to happen? We think this is an opportunity for people. People are gonna hear things that maybe they thought of, but they're not doing enough about, or they didn't realize how important they are, or they've never heard of them before, or never thought of them before. And that's the opportunity. And a lot of those people are probably gonna say something like, I should look into that. I haven't taken that into account in my retirement plan. I should do that. And then what tends to happen, Will, when we have people that do that? What tends to happen?
Well, a lot of them, as we go through the process, we see really the relief that comes through them, because a lot of them, like you alluded to, Paul, they have no idea where they're at right now because they don't have a plan. So just getting that plan together gives them that mental well-being and a sense of security moving forward into the future.
Exactly. When people get going, they feel really good about it. But the point I was trying to make is that a lot of people want to get going, but they say things like, I'm too busy now. Oh, I've got this going on at the work, at the office, the kids at home. And they'll say things like, call me in 3 months, call me in September. And then we call them in September. Well, what happens then?
Well, in September, they're more often than not still busy in September.
Bingo, right on it. So that's the thing. People say, I'm too busy right now. Call me in 3 months, 6 months. I got news for you. If you're busy now, you're going to be just as busy in 3 months or 6 months down the road. And then what happens? Years and years and years go by and nothing happens. So that's the kind of the cycle we want to hopefully stop today. Just a bit of a commercial about us at West End Wealth Planning. We're a bit of a boutique wealth planning service associated with IPC Securities Corporation, one of the larger firms in the country. And what we really try to do, we focus on dealing with business owners, successful people and professionals who really want to accomplish one of 3 simple things. Either they want to create a work optional lifestyle for themselves if they're still working, or if they're retired, they want to have a worry-free retirement, nothing fancy. And the third thing people want to do is leave an ongoing legacy. So what we've done is we've created a process, and the process helps put our clients, all of the puzzles, all the pieces of our clients' financial puzzle in one place. So they always know where they are and they always know where they're going. And we call that the guidepost formula. So again, if you'd like more information on that, you can simply go to our website, westendwealth.com, westendwealth.com. So why do we want this topic? Why is this? Well, if I was to ask most people, Will, what is their life's biggest financial obligation? Well, what do you think a lot of them would say? Any ideas?
Usually the family home.
A lot of the time, the family home. Actually, that's not true. If you look, for example, you did some numbers, Will, you did some numbers for us, and to create $75,000 of after-tax income for 35 years, you need $2.4 million. Well, the average home here in Toronto is just over $1 million. Now, a lot of people own more expensive homes, but in fact is what's likely is your retirement nest egg is your biggest financial commitment. But the biggest thing, people often don't think much about it. So, for example, I would like to ask Yana to put up the first poll question now. Can you do that? We're gonna have some fun here. We're gonna ask all of our participants a poll question. There we go. So we're gonna give you a few minutes. Real simple question. How many of you have a written retirement income plan that has been updated within the last 3 years? Yes or no? That's all there is. So again, take your time with that. And really, when we talk about wealth planning or retirement planning, well, there's really a couple of major things that you want to think about. First thing, how many people would build a house without a set of blueprints? Not too many. So again, you'd end up with a real messy looking house that wouldn't probably last too long. How many people would go on a trip without some type of plan in their head where they want to go? How many people even go to the grocery store without saying, okay, I need this or that or the other? You may pick up a few more things. The fact is we do planning for the most of our life, but I wonder how many people actually have a retirement plan, their biggest financial commitment. And we have some results here now. Look at this, Will. 64% of people do not have a written retirement income plan that they've updated in the last 3 months. And by the way, the update, why is the updating so important, Will? Thank you, Yana. Yana's taking care of all that's great. Thank you so much for putting that poll up there.
Well, the updating is like getting the initial plan going is great. That's the first step, Paul. You're right. But then as your circumstances change, you need to continuously update that. Your circumstances are always changing. I know me, I'm still young. When I'm retiring, when I'm getting closer to that stage, my life is going to look a lot different than it does now.
I would even say, even if people think back now, what was important to you 5 or 10 years ago? I think you're going to realize that even just 5 or 10 years ago, what was important to you is different than what it is right now. How different was the world 5 or 10 years ago? My gosh, things change so quickly today. And then you look 5 or 10 years or 15 years down the road, you're going to have different priorities in life, and the world will be different. You need to update this. Again, your biggest financial obligation you're likely to have in your entire life. Do you recall Dwight D. Eisenhower had a wonderful quote? Do you recall the quote, Will?
Yeah, I'm not going to get it exactly, but to paraphrase, it's you probably the exact
I
quote.
know. Dwight D. Eisenhower, which was the famous general for the U.S. Army in the Second World War and president in the U.S. in the 50s, he said, plans are nothing, planning is everything. And that is absolutely so true. Okay, so that's great. Thanks, everyone, for answering that question. Why don't we get going with critical retirement blind spot number 1? And by the way, again, want to mention everyone, please ask your questions. We're going to try to answer whatever we can. I have the screen right in front of me here. So if you have something you want to ask, feel free. Again, you can ask anonymously, or if you'd like to ask us a question directly to Will and I, you can simply go to our email, info@westendwealth.com, info@westendwealth.com, the only important email address anyone needs.
So Paul, let's get started. What's the first retirement blind spot people need to be aware of?
Well, let's first ask a question. How long do people think they're going to live? What type of things do we typically hear when we do a retirement plan? And maybe we do a retirement plan and project it out to someone age 100. What types of things do we hear often from our clients, Will?
Well, they often say, Paul, I'm not going to live to 100. Why are we planning for that long?
Bingo. Hear that a lot. I'm not going to live to 100. Don't worry about it. But I'm going to tell you, everyone listening, a story. And this is a real story about a real client of ours who, this gentleman, a successful business owner, he owned a consulting firm, did well for himself, retiring about 68 years old. And he had no, it wasn't important to him to leave a legacy, but he said, Paul, I don't want any risk in my life. I'm just going to put all of my money in the bank. I don't care if I get 1%. And I have enough that, maybe when I'm in my early 80s, I'll sell my home and that'll be fine. And we ran some numbers based on that situation. And his money ran out in his late 80s. He says, that's fine. I won't last any longer. But I did some projections. And I looked at the Government of Canada website and it said, in 1991, the Government of Canada suggested that someone 68 years old would last till about 82, 83 years old. However, in 2019, the same Government of Canada website said, now we expect a person to last to about 87 or 88. So I projected that for my client. I said, look at, John was his name. And I said, John, if the same increase in lifespan continues, you have a 50-50 chance of reaching 95. So you got a big chance of running out of money. Now, a lot of people may say, oh, who cares? I'll worry about it then. That's like going on a plane with about a 50-50 chance of having enough fuel to get you to where you want to go. Again, your biggest financial obligation that you're going to have. By the way, people, we have clients say, well, that clients whose parents are still going strong in their 80s, 90s, and even longer, don't we? I mean, we have one of,
Absolutely. With advances in healthcare, people are living way longer than they used to.
I mean, we've had one of our better clients. This is his father, his parents, they were playing tennis up till virtually 90 years old. So let me put up, I'm going to put up, share the screen for our clients or for our participants here. And bear with me here, everyone. This is a snapshot of life expectancy in the United States. This starts at 1921 and goes to 2018. Does anyone see a trend here? Anyone see a trend? Obviously, there's a trend for longevity to increase. And the thing that happens that most people don't realize, because longevity is slow, increases in longevity is slow, we as humans, we tend to miss it, don't we? So, whereas things that happen immediately, we tend to sense right away. Okay, so that's it. So again, what do we do about that? When you do your retirement planning, which remember, most of you don't have, but you darn well should have, most of you, when you do it, you want to project out to at least age 100, and I'm suggesting even longer, because you never know. We've had people, their parents living well beyond 100 and are in good shape. They're in good shape and they need money.
Well said, Paul. Retirement's the last time you should be worrying about running out of money, so it's good to plan conservatively in this regard. Why don't we move on to the second blind spot, Paul?
Okay, and that's an interesting thing here. Now, what happens is that most people, when they're looking at projecting into the future, they look at history, don't they? For example, they'll look at an investment. They'll say, this investment earned 6% on average. It'll likely earn 6% moving forward. But things change. Now, for example, 20 years ago, interest rates were much higher. You could buy a portfolio of all bonds, like all bonds, no stocks, no stock risk whatsoever. And you'd probably earn 7 to 8% a year on it. We are just finishing a 40-year bull bond market. But that's not the case today. If you buy a portfolio of bonds today, you might earn 1%, maybe 2%, depending on you want to buy some corporate bonds, whatever. But you're not going to earn nearly as much. So you need to think differently. And let me show, again, I'm going to share the screen here. Bear with me here, guys. I'm going to share the screen. This shows very clearly here the difference. I hope people can see that. I hope people can see that there. Whoops.
Yeah.
Let's get rid of that. What this shows is the difference. In 1995, you could have a portfolio all of bonds and probably earn about 7.5%. At the same time, let me do this here. In 2015, well, now you can only have, or 2005, you'd need about half of your portfolio in bonds and half in other stock investments that obviously entitle more risk, more volatility. And by 2015, look at this, only about 12% can be in bonds to earn that same 7.5% return. But here's the big thing down here below. This represents volatility. You notice here, 6% volatility, 8.9 and 17. What we're saying is to earn the same rate of return, you need to be creative these days. What worked in the past is probably not going to work today. You need to be creative. And unfortunately, you're probably going to have to expect more volatility. We don't like that, but that's what happens. Now, by the way, maybe we just briefly talk about the difference between risk and volatility. So I've talked about this lots of time, Will, and you've shared this with me, obviously. So if someone were to say, if we were to say, what is a risky portfolio? What types of positions would be in there? What would you be looking at? Like penny stocks, small risky stuff,
Yeah,
startups.
it depends. Risk means different things to different people.
That's right. Now, because we've had people come to us and say, well, I want no risk and I want a good return. Well, here's the thing. Some people say, I don't want to buy any stocks. I don't want any risk. And I say, well, would you buy a GIC at the Royal Bank? And I'm not picking the Royal Bank just because of any reason. They're the biggest bank, so I pick them. Would you worry about buying a GIC in the Royal Bank? Well, everyone says no. Why would I worry about that? Well, what about buying shares in the Royal Bank? Stocks. Would you worry about that? And most people kind of go, well, probably not, no. But you understand, people don't worry about the big companies, the Royal Bank ever going bankrupt. And you can buy shares in the Royal Bank and the yield is probably around 4% right now, where a GIC is probably paying about 0.5%. Why wouldn't you want to buy the shares? And by the way, you want to be aware though, that the shares in the Royal Bank, just like all the other banks, probably dropped about 30 to 35% in 2008 during the financial crisis. But that's not risk, that's volatility, and that's normal. Of course, all the banks earned all that money back, plus a lot more in the ensuing decade. So again, you want to understand is that what worked in the past may not work in the future. And what you need to do about that is first thing, you need to have a realistic long-term rate of return. And well, I'd say a lot of people who we talk to, a lot of them don't really have a realistic rate of return expectation. They expect something with no volatility. If they were at 5, 6, 7%, it doesn't work that way. And again, you got to be a bit more creative. Okay, great. That's critical retirement blind spot number 2. Let's go on to number 3.
Great. So next, I guess we can talk about how retirees face the challenges of how much income they're going to need on an after-tax basis.
Well, that's it. Actually, you hit it right on the head. After tax is the key. We see too much planning done on a pre-tax basis. And those of you who ever used to listen to me on the radio, I used to say the same thing all the time. The only important dollar is an after-tax dollar. Before the government takes their slice, I don't care. I want to know what's in my pocket at the end of the day. That's the only important thing. And here's, I think, where we get a lot of misrepresentation. A lot of people are unclear. For example, well, don't we often hear people in retirement, we do the retirement planning, they're drawing out a certain amount of income, and that's the amount of income that we plan and they do. And what do they say often? Will, they say, I'm spending all my money. I get $1 in, $1 goes out. But then what types of things do we see in their balance sheet?
Well, after they say that, we'll often look at their balance sheet and just note that year after year, the cash in their savings account is actually accumulating,
That's right. So
it's getting
uh,
higher and
our,
higher every year.
not uncommon at all. People say, I'm spending all my retirement money, everything that's coming in is going out. But then we look and says, geez, you had $20,000 in your bank account last year. Now you got $35,000. You didn't spend all your money. There's another $35,000 that you didn't spend. That's where you want to be realistic in terms of what your needed after tax income, because uh, that can tend to happen. And the exact opposite can happen too, can't it, Will? Where you have people who
Yeah.
want to hang on to the higher lifestyle, where they insist on having two cars and boats and holidays and all this stuff, and often give a substantial amount of money away to their kids. Nothing wrong with that, but then they have to realize, well, that may lower what you have for yourself. It may lower what you could put, what you can income you can create for yourself down the road. And
Absolutely.
now, psychologically, I think there's actually, we've got a question here now. By the way, any questions, please go down below, go to the Q&A area. We're happy to deal with your questions. Or if you'd like to send us a question individually, simply go to info@westendwealth.com. Chris asked a question about, when I reach 65, can I stop paying CPP even though I have an income from my RSP? Now, I'm not quite sure what you mean there. Um, but Will, you have a comment on that? Because I'm not 100% clear on the question.
Maybe he can clarify. I think what he means is, um,
Maybe
maybe
it's
to clarify, but can he stop paying the CPP premiums if
maybe
he's
that's it.
withdrawing money from his RSP? That's how I read the question. Maybe he can clarify if he means something different.
Yeah, I mean, you have to pay CPP. Well, I should qualify that. If you're working and you have an employment income, you have to pay CPP while you're working. And by the way, this is one of the things about CPP many people are aware of. You may have already maximized your benefits, and every additional dollar you put into CPP, um, you can stop there. It may be someone who's employed. So if you're employed, you have to keep paying into it, even though you get nothing else, not one penny more out. Now, if you're a business owner, you have an option. For example, a business owner can say, okay, I can contribute more to Canada Pension Plan, but I'm going to get nothing else. Instead, instead of paying yourself a salary, you pay yourself a dividend. And when you pay yourself a dividend, you don't need to pay CPP. And that can be a big saver. By the way, you can go on CRA website for people in that situation. If you're self-employed, you can go on CRA website and you can look down the road and say, will I generate more CPP income if I pay more into it? So, okay, great. So where were we here now? We're
So
talking
we were
about,
on the third retirement blind spot. So maybe it's a good plan now just to wrap that up before we move on to the fourth blind spot.
yeah, I just wanted to mention too, one more thing is that people, when they retire, psychologically, the great majority change. And what I mean by that is um, because they've stopped with their paycheck, they tend to spend less because they're more worried about their money. And it's a natural human. When I retire, I'm guessing I'll be the same way. I'll say, look, I don't get a paycheck anymore. I don't have a pension. Most of us aren't fortunate enough to have a pension. I've got my portfolio here. That's what I got. You're going to be very careful. And that tends to be what happens because you're worried about money running out. And the one thing people don't want to do in retirement is worry. So what do you need to do to get around that? Well, again, you have a plan, a written retirement plan, because that'll tell you what you can take out on an after-tax basis. And it'll tell you if you're taking out too much, it'll tell you that you're taking out too much, you're putting your nest egg at risk. You don't want to do that. Without that plan, you really don't have an idea.
And
So
your advisor should be helping you through this process, helping you through that budget process, like we do with our clients, to help determine an accurate number that we should be using in our retirement planning.
Again, that's what a good advisor does. That's quite honest what we're paid for. So it's nice to do what we're paid for. Okay, what do we go on to retirement blind spot number 4? This is one of my favorite, but William and I were chatting earlier, and we want to talk about, well, William, why don't you start us off here? Because we were
Well,
talking about this earlier
the
today.
next blind spot is going to be the behavioral biases that we all experience when we go through this planning and process. It's just human nature.
Yeah, every single one of us have inbred biases. And the thing is, often we don't realize it. As a matter of fact, most often we don't realize it. And it makes us
The
make
thing is,
some
I'll
real,
add to that, Paul. Even like me and you and other people who've done a lot of research into this, and are semi-aware. Well, not semi. We're aware that they exist, even though we experience them ourselves. We often don't notice it during the fact.
exactly, exactly, exactly. And they affect all parts of our life. When they talk, they're going to affect your investment decisions and your life decision. So we just want to talk about a few of these today and give you an idea, because one of the things, well, we'll talk about that at the end. So why don't we talk about the first one, Will? And I
So the
think
first big one that a lot of people talk about is confirmation bias.
yeah, now what is, and I'm going to quote, I have here, American physicist Richard Feynman, very famous. I think he won a Nobel Prize. And he has a quote, and it's beautiful. He says, the first principle is that you must not fool yourself. And you are the easiest person to fool. And I've been in this business 30 years, and every year that is absolutely true. And it applies to all of us, me too, by the way. And let's talk about what confirmation bias is. Let's pretend everyone out there, some people are politically either a little bit more right wing or a little bit more left wing, and it doesn't matter which one you are. If you're a little bit more left wing, you're going to tend to read articles and listen to people who who agree with a more left wing view of politics. And if you see an article written by a right wing columnist, you might say, oh, I'm not going to read him because he doesn't know anything. We're all going to do that. Or it's the same as what's the best way to cook a certain meal. We're going to read how that person does it the way we like to do it. Or if you're an Apple fan versus a PC, you're going to say, oh, Apple is great. I don't want to read anything about PC stuff. They're not nearly as good as Apple, or vice versa. Or who's the best golf player, hockey? It doesn't matter. We all tend to read or information that will confirm what we already think, even if what we already think may not be correct. As what Mark Twain says, one great view, he says, it's not what you don't know that hurts you. It's what you know for sure that just ain't so. One of my favorite quotes. So again, confirmation bias, every single one listening here has confirmation bias. William has it, I have it. One of the best ways to deal with it is just to be aware of it. When you're making a decision, say, hey, is there any confirmation bias? Just think about it. And it may make you change your decision. You never know.
Yeah,
What's
it's
the next
always
one, Will?
good to get a different opinion.
Yes. So what's the next bias?
The next one is overconfidence bias.
Okay, overconfidence. Now, overconfidence or being confident is actually pretty good in a lot of fields. If you're a rocket scientist, or if you're a surgeon or an engineer, you want someone who's confident. They're so well trained, they know their stuff so well that they're going to do well. But investing, it's not really the same thing for investing. And I'll tell a story about a friend of mine. This is Sam. Sam is now just retired. He's a successful engineer, did very well for himself in life. And we're actually about a year ago, we were on the golf course. And he turns to me, we weren't talking about anything. And he turns to me and says, Paul, one of the biggest mistakes I ever did in my life was when I first got out of university, I invested in a stock. And the worst thing is, I made lots of money on it. He says that was the worst thing that could have happened to me. In other words, I thought it was easy. And I realized later it wasn't. He happened to buy IBM shares. That's how, telling you how old we all are here, except you, Will. So again, the same type of thing happens like Robinhood investors. Now, to let our audience in, Robinhood is a do-it-yourself investment firm in the States that's become hugely popular during COVID. And all sorts of young people in their 20s all of a sudden started getting checks from the government and started putting it in Robinhood. And a lot of them made good money because last year, between April for the year period, what percentage of US stocks made money during that 1 year period?
So the answer is 92% of US stocks made money last year. So basically, a monkey, for the most part, could have picked a winner.
Bingo. I could have hired a monkey to throw darts at a wall and they could have picked a winning portfolio. The problem is, let's look at that historically. During the period January, the 10-year period from January 2011 to December of 2020, only 42% of US stocks made money. Now, in all fairness, another 22 were gone, they were delisted, but some of them merged and did okay. So maybe half of stocks made money. So I think what's going to happen here is that a lot of these Robinhood people, when the market goes into a normal downturn and they're going to lose money, there's going to be a little bit of dust on the floor. And some investors are not going to be really, really happy. They're going to realize it's not so easy. One of the things you always want to be in investing. What does Warren Buffett say? When you're an investor, what should you always be? Humble. Be a humble investor. So, what's the next bias we got here, William?
Well said. Well, another one is hindsight bias, which is very important.
So hindsight bias, what do we all do? By the way, I want to mention, everyone, if you have a question, just simply go to the tab on the bottom, the Q&A, and we're happy to do our best for to answer our questions online. If you have one you'd like to ask us directly, simply go to info@westendwealth.com, info@westendwealth.com. I'm talking to Mike, excuse me. I need a drink. Okay. So hindsight bias. Everyone out there, when you go to buy an investment, what's the first thing investors want to see when you recommend an investment? Well, what's the first thing?
Well, the first question they almost always ask is, well, how's this done before? What kind of performance numbers has it had?
Has it done well? So if we showed them an investment that's done poorly in the last 2-3 years, the chance of them wanting to buy it is not very high. However, most of us want to buy things that are low that go high. Now let's talk about last year. Do you want to talk about ARK? Probably most people aren't familiar with ARK.
Yeah, so ARK is it's an ETF, an actively managed ETF that came out in 2015 or so, and it's managed by a woman named Kathy Wood. And she's invested in all the new high-flying technology stocks, whether it's Shopify, Twilio, Tesla's their biggest holdings, so those types of holdings. And over the last year in particular, year and a half or so, they've done amazingly. Obviously, Tesla has been one of the best performing stocks. So of course, her ETF has kept going up and up and up. And as it went up, of course, because people saw her past performance, has the ETF kept doing better and better. It kept attracting new investors. Now, the only problem there is, like you alluded to, Paul, past performance does not always equal future performance. So ARK had big drawdowns in February of this year. I think it went down 30% or so. I don't have the exact.
About 30%.
Yeah, it had a big drawdown. So most of the people who invested in it just invested very recently. So they've actually lost money on it, even though it's just a short-term downfall. If you were in it since the beginning, you've still made a lot, but most people weren't invested with it since the beginning.
Yeah, it's incredible because we see this all the time. If you look at a chart showing when the money went in, ARK made over 100% in calendar year 2020, over 100%. But if you look at when all the money went in, all the money went in near the top. People saw, wow, this did fantastic. I want to get in on that. Fear of missing out. A lot of them put their money in.
Investing was that easy. You could just look at past returns and just pick that and then go to sleep.
Yeah. A neat thing if you want to look at, people look at history to judge what happened in the future. But history is merely the recording of surprising and unpredictable events that happen in the future. Do you see a paradox there? It doesn't make sense. All these big events that happen through history were all surprises and unpredicted. So moving forward, using them as a predictor, in a sense, doesn't make any sense. So maybe we'll go through maybe one more of these, Will.
Yeah, or maybe we're getting light on time. Maybe we should wrap up the biases and just conclude. How should that be used for retirement planning?
Okay, so the biggest thing, and there are a number of biases, we just scratched the surface. The best thing to do, as Will, as you alluded to in the beginning, is just be aware they exist. And then you can question yourself. I'm going to make this decision, whether it's about an investment or whether it's about my life or business or whatever. Am I being subject to loss aversion or the bandwagon effect or confirmation bias or one of the many, many biases that every single person on earth is wired in their DNA? And if you do, it might help you make some better decisions. Okay, if we have time, maybe we'll come back to a few more later.
Absolutely. There's lots to cover there. I just want to make sure we get everything and be respectful of our attendees' times here.
Okay. Again, mention to everyone, by the way, Q&A, we got a question down the bottom, or info@westendwealth.com.
So Paul, as we move on to retirement blind spot number 5, why do most investors earn a lower return than the investments they own?
Oh, that's a good. We should repeat that because I'm guessing many of our listeners weren't clear. If you look statistically, the great majority of investors earn less than the investments that they own. Now, that sounds kind of weird, but why don't we pull up a poll question? Yana, can you put up poll question number 4, please? So again, an investor earns a lower return than the investment he or she owns. Why? Because of fees, fear and greed, or something else. So give people a couple of minutes to answer that. And with that, we'll talk a little bit about Delbar. Now, Delbar is a company in the US. They're not a money management company. They strictly review investor behavior. That's all they do. They're well known. They've been doing this, I don't know, for 20 or 30 years. And every year they come out with a report. And the report is a comparison, essentially, of what the average investment earned and what the average investor who owned that investment earned. And every single year, without any exception, the average investor earned less than the investment that they actually owned. Now, they explain why. So again, if you take another couple of minutes, those of you who have not answered this poll, simply check off an answer that you think, and then we'll have some fun discussing this. So we'll do that. By the way, here's a great example here. This is right from Delbar. Many of you remember 2018 was not a good year for the investor. Virtually all world indexes were in negative territory. And November and December were the worst. Matter of fact, I believe December of 2018 was the worst December since 1932 or 33. It was not a fun month to have your money invested. Again, give people a couple more minutes. Please answer the poll question here. It might be a little confusing, but let's go back to my example here. So 2018 was a rotten year. What Delbar found was that in 2000, oh, there we are. Okay, great. So the majority of people feel it's fees and many other fear and greed. Well, fees is the wrong answer. It's completely the wrong answer, but that's the one we get most. Thank you very much, everyone, for answering that question. Great. So what Delbar, let me go through my example again. Delbar found 2018 was not a good year. And what happened in January of 2019, and by the way, 2019 was a great year. The US market went up over 30% in 2019 versus a loss in 2018. Great year. You know what happened though? In 2018, it was a rotten year. there were positive inflows into the investment market when things were going down. In 2019, every month from February through November, there was withdrawals. When the market was booming, people were taking their money out. Why? Because they saw the numbers from last year and they says, oh, this isn't any good. I'm not going to buy now, until they saw the market was booming at the end of the year. And in December, finally, there was positive money going into investments. So the main reason that Delbar finds this happens every year is because people buy their investments often at the wrong time, and they sell them at the wrong time. And every single year, Delbar comes with this type of study, and it always says the exact same thing. And and I believe the average is about 2 or 3%. If you go back 20 years, that the average investor is about 2 to 3% less than the investments they own. And I think we all know why that is. Will, do you want to add anything to that? Would you like to add something?
No, I have nothing to add. It just goes along well with our conversation on biases and why people do what they do.
Yeah. The other thing too is people tend to look at their portfolio over an average, according to Delbar, about 4 years. But if you have people that own a piece of real estate, they'll tend to look at it as a 10 or 20-year investment. They're not concerned if the real estate market gets soft for a year or two. They go, oh, everything will be fine in the long run. But with their stock investments, a lot of people, they look at it differently, don't they, Will? I mean,
Absolutely, yeah.
we've had people call us, clients, and say, my account went down last month. Why? And what's the difference? What difference will it make if your account goes down 1 month or the market went down for 1 month? You have a plan in front of you that we've done for the next 40 years. That's your timelines, not 1 month.
So
So
now, Paul, with that all being said, what do our listeners do about this?
well, it's simple stuff. I just say that it's simple but not easy. It's like a lot of things in life. It's simple but not easy. It's simple to lose weight, just eat less. It's not that easy sometimes. So here's what you want to do: just simply ignore the media hype. The media is there to sell news time. They're not necessary to help you. Some of the most ridiculous things I've seen, and they come up regularly. You've probably seen them. Well, you'll see things like, if you would have put $10,000 in this stock 2 years ago, here's how much you'd have. Who cares? So what that, to me, and I say who cares, some people may think that's not the best comment, but what that's creating an environment with people is they're trying to find the next what they call a 10 bagger. They're trying to find this next fantastic stock that's going to double in value in a year. And the great majority of times when they try and do that, you end up losing money, because we've seen it happen. So try it and avoid the media hype. Avoid your buddy who's telling you that he's earned 15 or 20% on his return, but statistically it's shown that he hasn't, or he or she hasn't. And don't look at your statements every month. You don't look at the value of your home every month. Who cares? Don't look at the value of your statements every month. I suggest to people, look at your statements no more than once every 6 months, because it doesn't matter what happens in the intervening time.
So
Well, we're light
Paul,
on the questions here. I like answering questions. Those of you out there who'd like to ask a question, simply go to the Q&A spot below there. Still got lots of time. That's what we're here
as we
for.
move on here, Paul, let's get to our final retirement blind spot. Why don't you start touching on that?
By the way, I have a few more blind spots if we have time. Well, the last one is one that's often missed, and that's my favorite, is tax. We talked before, the only important dollar is an after-tax dollar. And here's an example. We have a client who had some money and it was loaned corporately. So it was in a corporate investment account, and taxation in a corporation, a passive account, is very onerous. And it starts from $1. And we looked at what he had an investment in, and there were two things. One, there was a lot of distributions in this account. Plus, all the fees were hidden. And because they're hidden, there was no deductibility of fees. And we did a calculation, and it worked out that he was paying, the account was about $400,000. And I said, Patrick, you're paying about $8,500 a year more in taxes than you need to. 8,000, to me, that's a lot of money. 8,500 bucks every single year, because fees weren't deductible, because there were too many distributions. It was an inappropriate investment for a corporate type account. In an RSP, wouldn't have made any difference, or a tax-free account. In a corporate account, it wasn't. So what I'm trying to say is, your rate of return is often not what your statement says. Your rate of return should include your tax return. What impact is that rate of return having on your tax return? Without that consideration, it doesn't mean a whole heck of a lot. Now, Will, by the way, you did some interesting numbers. I asked William to do some numbers for me. Do you want to go over them, Will, or do you want me to go over them? Comparison.
I don't have them ready in front of me.
I do. So what I asked William to do, we started with $1 million and two separate investments. And we went over 40 years. Now, many of you say 40 years, that's way too long. But if you're 60 years old, you should be planning for over 40 years. If you're 50 years old, you should be planning for 50 years. So two different investments. We assume they both earn 5% rate of return annually every year. There was only one difference. We assumed one was taxed every year like interest income or net rental income, because they're both taxed at the highest rate. We used 50 or 40% tax. Will, do you recall? Doesn't really matter. And
Yeah,
a separate 50. And we compared that to the same $1 million over the same length of time, earning the same 5%, except instead of that being taxed every year, it was in a deferred investment. So either a stock investment that did not pay distributions, therefore there's no taxable, an ETF, whatever. And if you go 40 years down the road, there's a difference. Even though you start with the same amount of money, same rate of return, same time period. At the end of the day, the interest income or net rental income after tax after 40 years was $4,990,000, $4.9 million, let's say. The deferred gain account, same rate of return, same starting capital, was 6.5 million. It was 33% more. Again, you're talking $1.4 million. That's a lot of money for me. I don't know about you. And it's simply by taking tax in the equation. We see this so often that it's often missed by people. They don't take into account the tax. They're looking on the statement. And what are they looking at? Well, that rate of return on there. Tax code situation, not that important. So now I think we have a question here. Great, we love questions. What do we mean by distributions, REITs, dividends? Okay, great question. What we mean is if you buy an investment, it can be anything. It can be an ETF, a mutual fund, a stock, where there's a payout, whether a dividend or interest payment, and that will be taxable every year in a taxable account. In an RSP or a tax-free account, doesn't make any difference. There's no tax. So now certain investments can have big distributions, and some are geared towards big distributions. For example, if you're retired, you may want a big distributions. Maybe you're in a low tax bracket. That might be good. You're in a higher tax bracket, that might not be good, and you don't need the income. Or you'd rather take a capital gain, because a capital gain, depending on a higher income, it may be taxed at a lower rate than a dividend. So I hope I answered your question there. All right. Want to talk about one or
there was another comment just on that question. She said you also have to pay capital gain on REITs.
That's true. There is capital gains on REITs. Some of them grow more tax efficiently than others. Each one actually tends to be a little bit different. But you're absolutely right. Our example was all after tax. So we assume that capital gains tax were paid at the end, and that's what was left. There was still 33% more cash in your pocket. Remember, the only important dollar is an after-tax dollar. Just want to quickly review our 6 blind
Yeah.
spots. William never wants me to go late on these things. Thank you, William. Okay. First business blind spot we talk about, and that is how old you're going to last. Most people do not take into account how long they're going to last. You got to approach this, assume you're going to last to 100. Second big blind spot is, where are we here now? Oh, that was the first one. First one was, oh, what's your biggest financial commitment? Oh, I'm sorry. I'm getting mixed up today. First blind spot, make sure you do your retirement planning out to age 100. And by the way, remember, if you don't have a written retirement plan, you're building a home without a blueprint. Okay, critical blind spot number 2, and that is you need to be creative. What portfolio earned you 7.5% or 6% 20 years ago will not do the same today. We're finished with a bond bull market. You need to be more creative moving forward. Retirement blind spot number 3. You need to take tax into account when you're determining how much after-tax income you need. Remember, most people when they retire, they think differently about money. They get more conservative. Again, really key to have a retirement plan and a realistic number in terms of how much money you're going to need moving forward. Critical blind spot number 4, taking into account the biases that we all have. And there's lots of them. Boy, the more reading I do about this, the more I realize how biased I am. Again, by the way, if you want more information on biases, just send me an email at info@westendwealth.com. We can send you some information on that. Number 5, I'm sorry. Why do most investors earn a lower return than the investment they actually own? It's because they buy and sell at the wrong time, often because of media headlines. And actually another thing, fear of missing out, right? We see an investment that's going up in value. You don't want to miss out. I got to buy into that. Unfortunately, we often buy in at the wrong time when it's too late. Critical retirement blind spot number 6, taxation. The rate of return on your portfolio is not the rate of return unless you take your retirement or unless you take your tax return into play. By the way, just a couple of little things here. Well, we have inflation is another big item that's often not taken into account. Will, do you want to go with the rule of 24? Do you want me to do it, or do you want to just chat about it, how that can affect long-term income?
I'm sorry, on inflation?
Yeah, so for example, if you have what people often say to us, they retire and they say, okay, Paul, I've got $1 million or 2 million or whatever they have. They say, I want you to keep that even. I just want the income. So if I have $1 million today, if I have $1 million in 20 years, I'm happy after I've received my income. But that's not the case, because if inflation just averages 3% per year, the value of $1, the purchasing power of $1 is 50 cents in 24 years. So by keeping the value of your portfolio the same, you are losing money in terms of purchasing power every single year. Excuse me, I need some more water. So that's one thing I wanted to mention. And was there something else I had there? No, that's mostly it. Any more questions for anyone? We're happy to take them for you. Or if you have questions you'd like to ask us, simply go to info@westendwealth.com, info@westendwealth.com. And again, I wanted to say something that I said at the beginning of this. This is really an opportunity. We've already seen that the great majority of listeners today do not have a written retirement plan. They're building a home without a set of blueprints. They're going on a trip without knowing where they're going or how long they're going to stay, or whether they have enough money to take that trip. It's your biggest financial commitment. You have an opportunity now. Many of you may say, yeah, I should do something about that. Don't fall into the trap. The trap is saying, I'll get to it, but I'm too busy now. I'll look at this in the fall or next winter or whenever. But in the fall and next winter, you're going to be just as busy, maybe more busy. and that this is going to be going on year and year. By the way, as Will mentioned at the beginning, one of the things that we found is when people get going on a plan, when people get going on a program, they feel real good about it because then they can relax. They know things are taken care of. They can spend more time now with their family, their business, whatever, without concern. So those of you who are interested, chat with us about that, give us a call, or I'm sorry, send me an email, info@westendwealth.com, info@westendwealth.com. Also want to mention also our next webinar to be announced will be on Wednesday, September 15th at 1 p.m. We're taking the summer off. Yes, I like to take some time off too. And in the meantime, I hope everyone out there is staying safe. I want to thank you all for listening. It's been great to have you all on board. Oh, we have one more question. Maybe that was only 7, not mine. Not quite sure. We were going to do 6 blind spots, and we ended up doing 1 or 2 more. We weren't going to do 9, but there are lots more. We talk about them another time. Again, thank you all for joining us. Stay safe. Hope everyone has a good holiday in the summer, and you're welcome to touch base with us if you have questions in the meantime. If not, hopefully we'll see you in the fall. With that being said, I guess we're going to close shop for today, William.
Thank you, everyone.
Okay, cheers, everyone. Have a good summer. Bye-bye now.